What's up, trader? So today's video is going to change some of you in a very positive way if you just listen to it very, very well, because the thing I'll be trying to show you in this video is how I build my strategies. So building a strategy is not a very easy thing. It takes a lot of work, and I don't even think I can fully summarize all of that in one video. So that would probably have to be a series, but in today's video I just try to explain to you some of the steps that I look for whenever I'm building not just any strategy, but underline the word mechanical trading strategy. The reason why this video is going to transform some of you is because this is the one thing that I discovered in my trading which completely shifted my results. And that one thing was just simply mechanical trading. The opposite of mechanical trading is discretionary trading. And most of you, I'm not trying to tell you discretionary trading cannot work, but I'm just here to tell you, if you've been trading for a long time and you're still struggling to achieve any form of consistency, the markets already are very tough. Already you are struggling with psychology, most likely. It doesn't help to have a discretionary trading approach if you're still struggling. There are some of you who might find consistency with discretionary approaches, but for me, I strongly believe mechanical approaches will probably give you a 90% chance of becoming successful. Now, for those of you who don't understand, let's just look at the Google definition to make sure we get this very clearly. So a discretionary approach is basically based on human judgment, experience, and intuition. Now, basically, whatever this approach is that you have an understanding of the market, price action, etc. But every day when you go to the market, your analysis can differ. You understand? Like how you find a trade yesterday and tomorrow could be very different. If someone looks at 20 of the trades you've taken, probably 15 of them have a completely different reason as why you took that trade. So it's not a very consistent reason. And usually that reason is based on, of course, the market knowledge you have, but most importantly, your human judgment and experience. So maybe you've been in the market for a while, and when you see a certain pattern, you can tell yourself, I think when I see this should happen. But obviously that's the problem. You are thinking that when this happens, this should happen. And you are involving your intuition for subjective decisions. Now, this is the risk of using discretionary approaches. You are risking emotional bias and inconsistency because you are taking a setup based on how you think, and sometimes it can be influenced, with how you feel. So I struggled with discretionary trading, I think, for the first 2-3 years in my trading until the day I understood how to build mechanical systems. And since then, my trading has become simpler, very smooth. I have no stress in the market. I have less psychological issues. And basically, a mechanical system is just a system which is following a very strict and predefined rule, or you can call it a very systematic system. So when I go into the market, there is no room for emotions. There is no room for I think. There is no room for I believe this or this will happen. It is as simple as following my predefined rules. It's a systematic approach. If the rules come into play, click buy or sell here, stop loss here, TP here. If the rules don't come into play, we don't have a setup. It is as simple as that. You don't overthink, you don't question, you don't try to be right and think why this happened and why this didn't happen. And that's why I think I've also found a lot of success in day trading, because day trading is one of the best models I've seen to apply mechanical trading. I'm not so sure you can do this if you're a swing trader, and if you can, I just don't think to be very effective. So the advantage of mechanical trading, as you can see, it provides you with discipline in the market, but again, you have to be very careful to adapt to market changes. So now let's go back into our video. In today's video, I'll be trying to walk you through some of the few steps or some of the things I look for when building mechanical systems. I wanted to first make sure you understand the difference between the mechanical system and the discretionary approach. And then I also wanted you to understand the importance, why a mechanical system and not why the other approach. This is a market I'm testing on GBP JPY. Sorry, this is a strategy I'm testing on GBP JPY. Very simple setups, but they keep repeating and happening over and over. Like the setup I did for you a breakdown recently was here. It was a very simple setup. Pull back, got a pattern, got an entry. I've been testing the market. From that day, I've already got multiple other setups, but I've not taken all of them because I'm still forward testing and just trying to build confidence in this market. But you can see, like this setup, consolidation, breakout, retest, went to my direction. Consolidation, breakout, retest, went to my direction. Consolidation, breakout, retest to my direction. Like, it's a simple, repeatable model that you can test. If you've been watching my strategy on USD JPY, CAD JPY, then you have seen me doing the same thing over and over. I don't change my entries. The entries are repeatable. Every day look for the same thing. I took a setup, I think yesterday or 2 days ago. I did the breakdown on YouTube. I took this setup on my 200k FTMO account. See, we got a pullback, I got a pattern here, took the setup, riding the trend. Now, before we continue, let me share with you about this platform which will help you to buy and sell your cryptocurrency very fast and at a low cost without paying those chunky fees. Paybase is a cryptocurrency exchange platform which is well regulated, serves over 180 plus countries, and here you can buy and sell your cryptocurrency very fast within a short period of time. You can pay using card payments, debit cards, PayPal, of course depending with the countries. And as you can see here guys, in your first purchase there will be no fees, meaning it will be absolutely free. For your second transaction moving forward, you can get a 25% off if you use my code which is displaying right now on the screen, also linked in the video description. So if you're into cryptocurrencies and you want to start small, maybe with buying some coins like Ethereum, BTC, whichever coin you want, Paybase makes this process very easy and smooth for you. Now let's remember, trading cryptocurrencies in the financial markets carries some high level of risk, so this is not any financial advice. But again, if you're into crypto trading, feel free to check out Paybase. Do have the links in the video description. Otherwise, let's get back into our video. For you to build a mechanical system, there are a couple of things you must have in place. And these will basically apply to almost any trading strategy you want to build. You can never build a strategy without, get this very, very right, having a solid understanding of price action. Like, price action interpretation is bare minimum. You, regardless of what you trade, whether you trade ICT, SMC, whatever you want to call it, on the bare minimum, you must have a proper price action understanding. You should be able to interpret the structure of the market, understand when the structure shifts. Those are basic things you should be able to do. You should be able to read candles and understand what each candle means. When you see those long bodies, long wicks, whether it's to the upside or to the downside, what does it signify? You should be able to understand levels, whether it's support, resistance. For some of you probably use, I don't know, demand, supply levels. But you should be able to have a proper understanding of these things. You also should be able to understand basic market patterns, chart patterns, double tops, double bottoms, consolidation, breakouts. These things, you should have them on the bare minimum. If you don't understand these things, forget about building even a strategy. Because building a strategy usually is that you already have knowledge about what certain concepts mean and how they can work in the market. Then from the knowledge, we will now try to study different markets and see what is working more in that market. So if you don't have a proper understanding of price action, go fix that first before you even think of building a strategy. So that is point number one. The next thing I want you to understand is when building a strategy, it is not a very rosy process. It is not as direct as just do A, B, C and you find a strategy. It will involve a lot of trial and error. It will involve a lot of you testing out different markets. There are markets you will test, you will not find anything meaningful, and that's fine. There are markets you will test, you'll be able to find some consistencies, some patterns which are happening over and over, and they'll give you a clue of what you can expect in such markets. There are those you will test and you will just struggle to spot anything consistent. So this is how I'm usually looking at the markets when I'm trying to build mechanical systems. So you'll have to test out different markets. Now, the other thing you will now have to find in the markets you are testing is a way to define your bias or your direction. You cannot build any strategy, from my own experience, if you don't have a clear definition of an expected direction. For example, you should be able to tell yourself, if I see these and these on the higher time frame, my bias will be bullish for this market. If I see these and these on the higher time frame, maybe the daily or the 4-hour, my bias is bearish. So you must be able to define a bias in terms of direction in the market. For me, you've seen many times I use the long-term trend. As long as the long-term trend has not changed, I will keep riding with the wave of that direction. So that is how I define my long-term bias in that market. Then you also want to define a daily bias if you're an intraday trader. For example, just because the market has been buying for the last, 2 years, does not mean you can just buy any random day. That is why you see, for me, I have defined a daily bias, which basically is dependent on the previous day candle close. If the previous day candle close is respecting our trend direction, that is a strong bias for me to know I can continue riding the trend on the following day. If it doesn't respect the trend direction, I stay out of the market. So there is a long-term bias, number one, you need to understand, which tells us where the market is going overall, but there's a daily bias to help us to know, is this a good day to be in the market or not? For some traders who use ICT, I don't know, I see some of them looking for liquidity. I don't know if there's liquidity up here and this high, they'll be looking to buy the market until it gets there. It does not matter. Whatever concept you use, you should be in a position to identify where you're expecting the market to ride for the next couple of days or something. Now, any market, you cannot identify a bias, forget about it. If I look at any market right now that I'm trying to build a system on, and I'm struggling to even tell where it's going, hands down, I'm not continuing to trade that market. It's just as simple as that. I'm not even trying to waste my time to test it. You see on this market, I'm testing it and you can see multiple setups here. And what do you notice? Consistency in the direction, because I have a clue of the direction of this market. So I know exactly what I'm trying to test in this market. And in case it changes the trend, I should also have a way to define how do I know the trend has changed. So if you cannot answer these questions in that market, don't even think of trying to test, because it is only easier for you to start to test how your price action behaves in respect to an expected direction. You can't test price action randomly, or that will be testing blindly. For example, for me to know I'm looking for a consolidation here and a breakout, or for me to even identify that this was a consolidation and a breakout to the upside, it was easier because I came to this market primarily knowing it is heading where? Upwards. So already I'm trying to look for patterns that will help me to find a bullish setup, of which I can now see easily. There's a consolidation, breakout to the upside, retest, continue to buy. If I came to this market with no single clue of where the direction is heading, I will see bullish and bearish confirmations everywhere. Now that is the worst thing about the forex market. If you come to the market with no clue about the bias, everything will be a signal to buy or sell. So you will see this breakout here, you tell yourself, let's buy. You will see it here, and then you see maybe the market forming an M pattern, you tell yourself again, let's sell. So you end up with so much confusion because you are seeing buy confirmations, you're also seeing sell confirmations at every other time. So you don't know what to stick to. However, if you're coming to the market with a predefined bias, your work is very easy because you know the direction you're trying to ride, and it's easier for you to identify patterns which were able to give setups in that direction. So that point was majorly just about finding the direction, that if you can't find it on that market, forget about it. So let's continue with our breakdown of how I'm building my strategies. So the next thing, we already have our direction. For example, in this market, my bias has been bullish. That's what I'm trying to test right now because I'm trying to ride the trend. So now that my bias is bullish, what is left for me to now find my entries? So now how do I know that I'll be finding my entries here, and how and where? So for this market, I have bullish bias. Then I've already added another thing, which is a daily bias. My daily bias is the same thing. Previous day must be bullish. So any day I see a previous day which is bullish, for example, you can see I was testing a setup here with it yesterday, which is on Monday, December 8th. The previous day had to be bullish first, which was on Friday. Then I come on Monday to now look for my trade. So when I go on Monday, already I know I'm expecting this market to most likely go upwards. So when I'm testing my strategy, one thing also need to tell you is that you will need to be very open-minded, because we're not just testing a strategy, we are building one. The difference between testing a strategy and building one is simple. Testing a strategy means already you have a playbook and you're just testing it. But building a strategy is what we are doing, meaning we are not so sure what works and what doesn't. So we're just trying to look at different things, different stuff. How does the price action behave? Take some notes, eliminate some things, add some things. Then you can be able to now tell this is a model you can follow. But we're not coming into this market with an idea of what works and what doesn't. We are coming into this market well versed with price action, but now we are trying to study and see, based on the price action understanding we have, what is being respected more in this market. For example, you might have noticed already I've been using a lot of consolidations for entries. Consolidation, breakout, entry. Another person may come into this market and try to look for flags because that is all they know. But you might not see a flag sometimes. So that's why you need to understand the different patterns so that you can know, if I'm not seeing pattern A, is there any other price action pattern I'm seeing which can signify the same thing? So now, since on this day I want to buy, the next thing that I always do when trying to build my systems, you just try doing this and you'll see whether you won't find results. Go on the specific days that, based on your analysis, you thought the market should buy or sell, right? Like on this day, I thought the market should buy. Then when testing this market, I want you to try to always focus on what happened before the significant move of the day. Simple as that. For example, this was yesterday. The significant direction was bullish and I wanted the market to buy. At the end of the day, did this market buy? Yes, it went to the upside. If I delete everything, you can see at the end of the day, this market bought. If you look at this chart right now, you might struggle to see anything. You might even ask yourself, how would I have identified a trade in this market? Now that's why you need to understand price action, because if you don't understand price action, you look at this market and you ask yourself, where would I have found an entry? If all you understand is how to draw maybe a W pattern, you might not find a W pattern. So for me, I try to just ask myself what happened before the significant, impulse of the day happened. And on this case, I can see what happened before the significant impulse of the day happened is that we had a consolidation here and a breakout and a retest. So already it gives me an idea that is a potential entry model. Consolidation, breakout, retest. So then that you've seen it on one day doesn't mean on the other day you see the same thing. So again, I'll try trying to look for another day which was bullish in this market, go with the same idea. This is another day here which I was also trying to go along on this market. It was on Wednesday, I think 3rd December. Same concept. We had a consolidation here, breakout, retest inside the consolidation, and continue to go up. So now I've already spotted 2 times where the same concept worked. So already it gives me an idea that, you know what, that could be a potential type of setup in my playbook. So I'll just record that down. But keep in mind, this is barely 2 trades. This is not even a proper backtest. This is just you trying to study to spot repeatable patterns. You understand? Now, there's a day like this one here where did this market buy during the day? Yes, it bought. However, if on this day I was still waiting for a consolidation, I didn't get a consolidation. Instead, what did I get? I got a W pattern at around this point in time, then it still went up. So in my mind, I start to understand, okay, there are days I may not see a consolidation, but my direction will still be respected. But then in this case, what happened before the move of the day? A W pattern. So already I'm seeing that could be another potential type of pattern I could use for an entry. But again, this is very short-term information. We're just trying to go slowly, collect data information. Think of it as doing research. It's like you're trying to talk to 1,000 people before you can find out their thoughts, and then you will summarize all of that and try to find something consistent, just something like that. You understand? But the trick here is simple. Always go to those days where, based on your analysis or based on your playbook, you knew there was a high chance the market will buy or sell. Then just try to study what happened from a price action point of view before the move of the day. You will find either there was a pattern, there was a flag, there was a consolidation and a break and a retest. You'll find maybe there was a long pullback before the move happened. The more you keep recording these things, the more you'll find some which are consistent and happen over and over. Now, something that I want to keep insisting, this is short-term information. So this is not enough to build a strategy. This is just giving you insight on the possible behaviors technically of what this market does. Now, another thing you will find in the process of trying to record this setup is that you will find many questions. So when I'm trying to study these things, I always have a book where I'm writing down any possible question I need to answer, because when I'm testing this system, how do I know a 15 pip stop loss will work? I don't know yet. You understand? It's still a new model. So I don't come into this market assuming I'll use a 15 pip stop and a 60 pip TP. I'm just coming slowly, recording each setup. You might notice here I did a 4R comfortably. There's another day where you'll do a 4R and it doesn't teach you a TP, it does a 3.5R. So already I'm starting to notice if I keep looking for 4Rs, there are time I'll miss it, but I could have caught the 3.5R. So in my book, I'll just write some rough notes. For example, I need to figure out what is the consistent risk reward I should be going for. Is it a 4R or a 3.5R? So all these questions that I'll be writing, I'll answer them using long-term backtest. So right now I'm just trying to figure out what is probably working technically, what am I trying to question, what am I trying to answer. Another thing I try to answer is things like fundamentals. On these days, were there any news? If there was news, what type of news was it? Did it affect the market? Yes or no? For example, let's say I hit TP during CPI, and in my mind I'm like, does it mean I can trade during CPI or not? So you see, that's a question I know I need to answer. Is it okay for me to trade during CPI or not with my strategy? Now I'll simply record that question down. Then eventually, when I'll be doing my long-term backtest, I'll be trying to get answers to this question. I saw there's a CPI where I made money, and now the question is, can I keep repeating the same thing during every other CPI? So as I do my backtest for 1, 2, 3 years, I'll now begin to try to get the answers from the past CPIs in this market in the last 4 years. How has my market been behaving? And you'll clearly find out that maybe the CPI that I hit TP was just lucky. You might find out that out of, probably 20 CPIs, 18 of them failed. So already I get my answer that, you know what, as much as I hit TP during CPI, it is not a recommendable thing for me to do over and over. Another thing I'll be trying to find out as I collect this data is the time that my trades are happening. This setup happened at around, what time is it? 12:30. This one around 8 a.m. Each setup happens at a very different time. This one happened around, 7 a.m. in the morning. This one around 12 p.m. So already I'm noticing most of the setups are happening, maybe during the morning hours, around noon there or something. So again, as I collect my data, I'll want to record the times of every trade so that I can find an answer to be able to know at their specific time windows which I can tell are hitting more TP than others. In fact, already on the GJ market, I've already found out that if I keep taking trades which come later during the day at around 7 p.m.-ish, just when the market is about to, close the New York session around that time, or mid New York session, I've just figured out already most of them are not working well. The best setups I've already seen are coming between, morning hours to around midday 1, 1 to even 3, 4 p.m. But when it gets later during the day, I'm already seeing most of them are not, hitting my TP very, very well. Now, with a mechanical system, I have to insist to you, it is very specific. There is no room for guesswork and trial and error. Keep in mind, what we are trying to eliminate is you going to the market with confusion. So with a mechanical system, I usually answer very many questions before I can decide that this is a setup I can see in the market happening over and over. For example, you see right here we have a consolidation. There are very, very different ways to look at consolidation. This is a consolidation again, broke out, retested, I took a setup. Right now as I test this market already, this is just one question I'm trying to answer. So we have a consolidation which looks like this. There are different ways that the market will play out. This is a consolidation here. I'm gonna break out. So one of the questions I've been trying to ask myself is, should I just take the trade exactly at the retest and execute, or should I wait to see how this candle will behave at the retest? You see, so that's something I've not been able to find a consistent answer yet. That's why now I need to collect long-term data, because there are days the market will come to this consolidation and it will break strongly. So on such a day, if I'm just jumping in the setup because there is a retest, I'll hit my stop loss. But if I'm being patient to see how the market will behave when it retests the consolidation, and maybe I'm waiting to see some sort of wick or some rejection, then you see that's a more quality type of trade. So again, because I've not been able to find a very specific answer to that question, I just noted down in my notebook, I put a star on it, and as I test the long-term markets, I'll now be trying to answer all these questions. So for this market, some of the things I'm trying to answer is the timing for taking the trade, what times are more quality than others, the news, what news am I trading and what news am I not trading whenever I see them on the calendar. Something else I'm trying to answer is the risk to reward question. So far, most trades are doing a 4R comfortably, but there's multiple times where the trade only does a 3.5R and reverses. So I'm asking myself, is it worth it for me to always go for 4R every time, or should I be considerate and just do the 3.5R but then hit more TPs? I'm also trying to answer the question of break even, because I've already seen in this market, if I just put my break even quickly at 10, 20 pips, it will easily come back down and then go up to my direction. So I'm also trying to answer the question of what is the best level for me to be putting my break even in this market. There's so many things that I try to answer when I'm building the system, but all I can tell you is everything must have a definition. Stop loss must have a definition, TP definition. It doesn't have always to be a fixed stop loss of 15 to 45 or 15 to 60. Your stop loss could still be based on structure, but you should be able to define. If I'm putting it based on structure, for example, if I'm to take my buy trade here, let's say my stop loss will be below this wick. So you should be able to define, I'm putting my stop loss based on the wick of the last structure point. Like, it should have a very clear definition. So when you go into the market, you are repeating the same thing over and over. So now this point I've been telling you has been more about studying repeatable patterns in the market, trying to study what the presentation has been doing over and over. And also something else to mention, you might study this in different time frames, because now you're looking for that entry setup. For me, I like using the M15 because I'm a day trader. I like using the M15 because I get to get a lot of day trades, meaning setups which will close within a day. You understand? Less than 24 hours maximum. But if you choose to also test the 30 minutes of the 1 hour, it's fine. Because for some other markets, you might find entries on the 1 hour, depending with also the type of personality that you have. For me, I'm very content and very comfortable to execute on the 15 minutes. And I like it because, like you will see, most of my trades run within less than 24 hours. This was like a 8-hour trade. If you look at these other trades, same thing, maybe 5 hours, 6 hours, like very short-term trades. But if you execute on the 1 hour, your stop loss might be quite bigger, your TP might also be bigger, it may take longer to run. So it depends what now you're comfortable with. So you might also have to test different time frames before you can settle on one that makes sense to you. So after I do all these things, basically at this point in time, I've not even gone to my TradeZilla to backtest. I hope you understand. At this point in time, I'm just studying raw information on what I'm seeing on a day-by-day basis. Like, I want to buy on this day. What happened before the market went up? Consolidation, breakout. So I start to notice the same thing happening over and over. On this day, I want to buy. Did the market buy? Yes, it bought. What happened before the buy of the day happened? I can see we had a W pattern here. Sell, buy, came to the neckline, went up. So that could be a potential entry model. So at this point in time, purely raw information that we are collecting. Now, after we've collected the raw information, and now I have a bunch of questions that I need to answer, I'll have all of those things recorded like in a notebook. Now I'll go to my TradeZilla to do now long-term backtest. And also one tip, this raw information, you want to collect it from the most recent markets. If you're a day trader, you don't want to be, doing this using data of 5 years ago. Start with the most recent markets first to see what has been happening today, yesterday, last month, last week, just to get an idea and then get that raw information fast. I recommend you collect raw information for about 3 to 5 months. 3 to 5 months will be enough to give you raw information of, the things you're seeing happening in that market over and over, patterns, note them down, etc. By raw information, I simply mean just looking at your chart on TradingView, trying to spot the behaviors on that day without even going to do a proper long-term backtest using the replay. Because by the time you're going to TradeZilla or FX Replay or whatever you use to do the long-term data, it means already you have an idea of what you're looking for. You cannot backtest a market without having an idea. So you first collect raw information to just see what is working, what is not working. Then you write all those things down, write all the possible questions that are stressing you. Because when you start to test this market, I can tell you for free, you won't see everything clearly. Some things will make you get confused. Like you'll wonder, if I do the consolidation here, should I take it at this point? Should I wait for it to retest? At what point do I know this consolidation is no longer valid? What if this market continues to buy after the consolidation? It comes and retests 2 days later. Am I still using the same consolidation, that I marked 3 days ago? So that's a question that you just write it down. Then now as you go to test long term, you will try to see how these things have been behaving over a long period of time. Now, at this point in time, I'll now go into my TradeZilla. That's what I've been using for backtesting. You can see this is like GBP/JPY 2025, I believe, around 68 trades so far as I backtest. It's up around $35,000. Usually backtest the 1% risk, so just take this as 35% so far, up 68 trades from January to December, but it's not yet complete. It's only 66% complete. Now, the whole point is, now that I have the raw information, now I'll come to TradeZilla, try to now go and do the long-term backtest. I'll probably start with the most recent year. So like right now in 2025 December, I'll start with 2025, the 2025 first, to just see if I try to apply the things that I've been seeing in my 5-year worth of raw data. Also, the thing is, with the raw data you are collecting, sometimes you can be biased because already you saw what happened. You see, like on this day when I'm trying to collect raw information, I've already seen the day bought, I've already seen this happen, so you can easily be biased. But now, since we have an idea, we now go to TradeZilla, and this time we're now replaying candles without knowing what happened. So we just try to test and see if we were trying to execute that system, what was working and what was not working. As I do the long-term backtest now on TradeZilla, let's say for 1 year, I'll have multiple questions that I might want to now answer. The questions which I was getting from my raw information, for example, is there specific times which are more profitable than others? So I'll now be going forward as I record this trades on my Excel sheet, like the time executed, etc., all those things, so that I can now find out answers to the questions that were disturbing me. And the goal is, when I'm going to the market, by the time I'll be telling myself I've built a solid system in this strategy, I don't want to go to the market with confusion. I don't want to see a pattern, then I start asking myself, is the pattern okay or not? Is the consolidation good or not? Like, I want to be able to define based on my long-term data, if it looks like this and like this, it's a good consolidation, period. If it doesn't look like this and like this, it's a bad consolidation. Like, I want all those things defined based on my data. And if I can't define those things based on my data, then I can't have a mechanical system. And the whole goal of having a mechanical system is that everything is defined and you can see them happening in the market over and over. Now, as you collect the long-term data, some of the things you also now want to find out is things like losing streaks. You can see already there are some months here where you'll have multiple setups which are losing. There's a day where it took like 2 L's in a row, another L here, another L, another L. I think these are probably 5 or 6 losses in a row. It happened. But now you see, as much as there's a month where it took 6 L's in a row, you might notice this is the same month. This is the month of July. And by the way, fun fact, the same July, I had a losing month with my current UJ and CJ strategy. For a very simple reason, the markets were consolidating more that month, I believe. So I understand why we have a lot of losses in this market. But you see, it's giving me a picture that there's a time where we lost 6 L's in a row. It's just back to back, 1, 2, 3, 4, 5, 6. But this is July. But if I take you to the data and let's just check the session results, before the July where we've taken the 6 L's in a row, you'll still notice that there's multiple other months where we made a lot of money, because now this is this is the July where we've taken multiple losses. Eventually we were able to get some TPs and we almost closed at break even, but it was a negative 1% month. Before July, you can see the other months, a month like June, the system made about 3.4% return. A month like May, it made 10% return. It was now a very good month. So you see, we love months which are very good, months which are completely bad. A lot of losers. And I've always said this is normal. Expect to even lose 5, 6 trades in a row with some systems. The only thing that matters is that when you're losing month, you're not losing a lot of profit. As long as in my losing month, I am not wiping out profit for the whole year or profit for the whole quarter, and then I'm good to go. You understand? So this will just take you to have stable psychology for you to go through this period where you're losing this number of trades and without giving up, and you keep executing, showing up, etc. So long story short, which month were we? June was a 3% month, May was a 10% month, April was a 2.5% month, March was a 13, again, very, very big month, February was a 1% month, and January was a 4% month. So already you've seen, we're just having about, is it 4 months, which had some significant return. January at 4, we've had, I think, that's month 1, we've had month 2 here at 13, we've had month 3 at 10. So actually it's just about 3 months which have had very significant returns. We also have June at 3.4%, which is also not quite bad. Then these are losing month. This one, I'm still in the process of collecting data. But long story short, now this is where I try to find answers to most of the questions that I have about the system. And I'll do this probably for 1 year. After finishing 1 year, I'll have like an Excel sheet. So the Excel sheet, I'll record the time of the execution, the news that was there on that day, the stop loss, the entry, the best risk reward on that day that could have worked, the pattern that I use for entry. Is it a consolidation? Is it an M pattern? Is it a W pattern? I'll record all those things. Then I'll now study my Excel sheet after doing 1 year of data collection. As I study my Excel sheet, I'll be trying to find consistencies in anything that will help me to make the system better, either by increasing the type of TPs or by reducing the stop losses. So one thing I usually like to study is my losses. So if I notice I'm just losing, I'll try to look very carefully. So sometimes I might notice, on this day there was CPI. So if I eliminated to trade during CPI, already would have eliminated this, day as a trading day. So we take out these negative $2,000 loss. So that means if this month I ended at a negative drawdown, I'm going back into profit by just not trading during CPI news. Another thing I might notice is that when this loss happened, maybe the price action on that day had something significant which could have assisted me to know I couldn't have taken that trade. So I go slowly forward as I refine until I can find something which seems to make sense within that 1 year. So after I now do that 1 year, that's not enough. Again, I'll now go backward, now test 2024 last year. But now by this point in time, it's like I'm already sharpening my system. By this point in time, it's like I already have something close to solid. It's just that I now want long-term proof because I've already done the raw data of the 4 or 5 months. After 4 or 5 months of raw data, or at least 3 months, I've gone to Tradely and I've done a proper backtest of like the most recent year. Then from this most recent year, I've tried to study the losses, the TPs, the winners to see any consistencies, and I've tried to know the things I should do and not do. But it's still not long-term data. So now I'll go back, test 2, 3, 4 more years backwards. So meaning 2025, I'll do 2024, 2023, maybe 2022. So by that point in time, by the time I'm now done doing the last 3 to 4 years, I'll have long-term data, number 1, to give me confidence that this thing can work over time. Number 2, it will help me to refine to know what is a good setup period and what is a bad setup. So at this point in time, I won't be gambling. I won't be questioning, is this good, is this not good? I have 4-year data, 5-year data. Another thing that the data will help me to know is the consistency in my winning streaks and my losing streaks. I've told you very, very well. A good trader is one who knows how to anticipate losses. Without data, you can't know how to anticipate losses. If I show you the system and I just tell you, so far we are up $35,000 in 2025, for example, assuming this is a system I had executed, you'll just be happy and say, you know what, give me that strategy. But real time, you are not aware that there's a certain month where we literally took about 6 L's in a row. 6 L's in a row, if you do 2% risk in a profile, you've blown the account. You understand? 6 L's in a row, if you're doing 1% risk, you're in a very big drawdown at the end of the day. Now, did the system recover? Yes, it did. But you see, you need to be able to go to the market understanding what my losing periods look like based on the data. So another reason why I'll be doing the 4-year data is just to make sure I want to understand within the 4 years, what is the most amount of trades we ever lost in a row, so that I can try to understand if I was trading at that period in time, what could I have done to navigate? You understand, something like that. So again, I could talk about building a strategy for hours. We cannot finish this thing in one video. This is just some random video and I'm just trying to give you some random tips, but you can still pick them up together and use them to see what you can implement when trying to build your own mechanical and repeatable models. Just understand this: when building a mechanical system, you must answer every question. You don't want to go to the market second guessing things, not being sure, is this okay, is this not okay? Find all those answers in your data. Then once you find them and you go to the market, you do not overthink. You see your setup coming into play, you click the buy or sell button. You lose, it's okay. What matters is that we know that thing over time will always make more money than lose money. Now, when testing the system, there's also a part where you must have expectations. For example, when I'm testing a system, I won't just be there wasting my time for, testing a system for 3-4 years and it doesn't make money. So what are my expectations for me to know this is a good strategy or this market I can trade it? Whenever I'm testing a market, I usually want it to show me an average of a 3R return consistently. If one pair can show me it can give me 3R consistently, and basically 3R consistently is about 36% return for the year. So if I test the market and at the end of the day it gives me something like 36% return, for me I usually tell myself this is a very good pair. Now another way I always look at it is that it must not be 36, because realistically you might not make 3% every other month. You understand? And again, this is the average. It doesn't mean every month will be 3%. Month one can be 10, the other month 5, the other month 4. But at the end of the year, usually I want it to be somewhere close to about 30-36%. So sometimes I always tell myself, even if it doesn't make money every month, out of the 12 months of the year, it should make money for 8 to 9 months. So for me, as long as that market can show me it can do an average of 3R a month, that will be okay. Like you've seen for this market, it's already up above about 35% return, and I've not completely done the whole year. So like for that market, if right now we're at 35% and I think 8 months in, or let's just assume I'm 9 months in, with 9 months it's giving me an average of about 3.8R, which is almost a 4R a month. So already I am positive that, you know what, this is a system I can execute. Now the final thing after doing all these things will now be a forward testing period, which is exactly what I'm doing on GJ right now. Forward testing period is a period where now you have an idea of your system, but you want to try to be confident enough to make sure you can see these things happening real time. It is easy for you to backtest, it is easy for you to use a replay feature, but can you go to the market today, be there, sit down and wait for that setup to happen, catch it real time on your demo account, on your small live account, etc. So that is exactly what I'm doing right now with my GJ strategy. I'm simply trying to forward test just to make sure I can see these things happening on a daily basis. Like yesterday I saw this setup happening, we had another setup I think sometime early last week on Wednesday. So I'm just trying to be there and see, can I see them real time? And this one I might do for even a month or two sometimes. Where I am in my trading, I don't forward test for a long time, because I've already, the idea of forward testing usually is just to give people confidence. And me, I'm at a point where my psychology is already fixed. Like I don't struggle with trading psychology. So I'm not trying to forward test to, I don't know, to fix my psychology or anything. Even without this strategy, I'm already good at my psychology in the market. So I'm just forward testing for maybe a month or two, just to make sure I can see these things happening in the market and to understand what it takes to be there every day, to wait for this consolidation, to see it happening. Because again, if you see a market which has already played out, this thing looks so easy. But real time, it means I had to be here and wait for all these candles to form for me to see the consolidation and the breakout. This took quite a number of time. If you measure these consolidation alone, it took about 3 hours. So I'm trying to see practically how does it feel to be on the market on that day, to wait for this consolidation, to see it happening, see it break, seeing retesting, all those things. So I do forward testing for maybe a month or two, just to get in synchrony with my strategy and make sure I can execute it. My current CJ strategy, I did forward testing for about 6 months actually. But it's because back then I still had a lot of psychological issues and I really wanted enough proof this thing can work. But right now I think the most I'm doing forward testing is a month or two. If I do a month or two forward testing, after I already have 4 years worth of backtest data, you know, I'm ready to kick in the trading strategy and, you know, take it a live account. So basically that's how I build my strategy. I know I've ranted a lot in this video, I've talked a lot of, you know, stuff, but hopefully you guys have caught something. Those of you who've watched until this minute, you know, feel free to share your thoughts as well. If you have any question, any issue when building your strategy. If you also want me to make this a series, because building a strategy is quite a lot of work, and if you want me to make this a series, also comment down below and I'll make another video again about some of the other things in terms of the nitty-gritties and the details that I look for to make sure my strategy is very, very effective. Otherwise, till next time guys, peace.